Coffee Trades. I want to do a video analysis update of the stock market. We're going to talk about all the usual suspects, the big tech stocks, the growth stocks, the value stocks, the commodities, the EV, the ESG. And I'm going to leave all the thumbnails. Don't you worry about it. But you know what? I think my videos are getting a little mathy. And I'm going to start just giving my opinion, just giving my kind of regular opinion. I'm a little heavy on the fibs, the extensions, the implied volatility, ranking percentile, the betas, the correlation coefficients, all that stuff. But that just ain't working in 2022, is it now? Nah, that ain't working in 2022. This is the way in 2022, man. I've learned it. You don't need to actually talk about betas and correlation coefficients and buy right ETFs and delta dollars exposure and long gamma and nah, fuck that. Look out! Ah! Ah! That's the 2022 way, man. Isn't that beautiful? Look out! If you don't subscribe to my Discord, you're gonna be effed. That's the 2022 way, and it's working. It's working for a lot of people. Man. I'm telling you. I ain't jealous. I think I was jealous a little bit. When I saw this. I saw a couple people post this, get 500 likes, $40, $80 a month Discord. I got a little jealous. At first. But then I started to feel bad. I started to feel real bad. Because the S&P 500 was trending on Twitter recently. The S&P 500 was trending on Twitter recently on normie Twitter. I saw this on my burner account, not my FinTwit account, that the S&P 500 was trending on Twitter. I was like, oh man, I gotta click on this. Let's see what's at the top of this page, right? Oh man, 2008 analog this, 2008 analog that. We're going to 220 this. Thousands of likes. Oh my God. These are all the top, every single top tweet. You go on Twitter right now. Pause this video. Go on Twitter right now and search S&P 500 and tell me I'm wrong. Every single top tweet is a 2008 analog. They're all 2008 analogs. Most of them from people, hey, you give me $50 a month. I'll help you navigate it. Well, you know what? Screw that. I don't need to pay anyone $50 a month to navigate that. You know why? Because for the past 2.5 years, I've been in the notes folder. Putting in work. And I know what's in here. Baby. What's in here are the exact Greeks, the exact betas, the exact amount of readings on particular screeners that made this metaverse ETF straddle, where I bought the 10 strike call and the 10 strike put for $218, and in less than 2 months sold it for $298 for a 36% return in less than 2 months, which was my best straddle of the year. Just barely edging out Credit Suisse, or it was my best straddle of the year, just barely edging out Credit Suisse, which was a 35% return in 1 month. Now, that one kind of has an asterisk because that was a hedge on the Credit Suisse position I own. So there's an asterisk on the Credit Suisse straddle, but there isn't an asterisk on the AG&C straddle, where I bought the 12 strike straddle expiring in March. In mid-August, in less than a month, I sold that for a 57% gain and bought the 11 strike straddle for $232. And then in one day, I sold that for a 19% gain in one day. And I doubled the amount of strike prices. Sorry, I doubled the amount of contracts I had. Bought the 9-strike straddle for 181. I sold one of those in like a couple days later than that for a 27% return. And I still own one that's $251. I own half the amount, half the position, because when I readjusted my strike prices from 11 down to 9, I was able to double the amount of contracts I had. So I took profits on half of that lot when AG&C fell, and it was worth 231 from 181. And I still have the other half of the lot where it's worth 251 that was bought for 181. I know all what's in here that's made this systematic, that's made this AT&T straddle. AT&T and Verizon all over the bar chart, straddle and strangle screener. For months really on this way down, but particularly they were making lots and lots of readings recently with them reporting earnings in 2 weeks. So I bought the 15-strike straddle on October 10th. That didn't expire until June. This didn't expire until June. And in less than 2 weeks, I sold it for a 15% gain on an annualized basis. That's pretty ridiculous. It'd be 30% times 12, which would be a 360% return on an annualized basis. And I don't think I'm done with AT&T because I didn't exit the position. I just sold the 15-strike straddle and I moved the strike prices up from 15 to 17. So I'm still in AT&T. And I have the 17-strike straddle expiring in June for $299. And I bought that. And then I bought that on Thursday. And then on Friday, AT&T was on the bar chart straddle screener again for the 17-strike. I own the bets, the gambling ETF bets. I own the 13-strike and the 14-strike straddle expiring in April. I got those for $295 and $299, respectively. Now, that's a pretty risky one, but that's so I get a lot of exposure to growth. That's for me to really call the bear bluff in growth, but I don't think it's going to play out. I think that the call portion of these straddles is going to print. In ET, I've had two 25% adjustments on already. I currently own the 12-strike straddle for April, bought for $272, and the 10 put and the 12 call strangle for 2024, January of 2024, that I bought for $331. I think we have some oil stocks reporting earnings soon. The reason that I was in ET is the reason that I think that a lot of people are getting set up. Now, I've shared in a lot of videos that the ET, Chevron, Royal Dutch Shell, and BP were on this screener, the top 200 volume and open interest stocks with low implied volatility ranking percentile. I've shared that those stocks were on that in mid-November. This is a different picture from early December, December 10th. We see XLE and we see Oxy all over this screener. And that's when I was really hitting the hammer with Oxy and XLE. And those both did really well. So I'm not saying that, obviously not every stock I've talked about in 2022 has done well, right? But what I'm trying to show is that I've been studying straddles and strangles and these liquidity filters for a little bit. I've developed a system where 15 to 35% returns in less than 2 months on directionless trades are commonplace. They really are. All types of stocks, all types of sectors, all types of environments. It's getting really systematic. And there's a lot of great things going on in this notes folder. And I'm slowly kind of sharing, what I've come up with by putting my money behind this, right? And the beautiful thing is that I have built a system where all of these straddles, all of these strangles could reach max decay. I could sell them 2 months until expiration, and they were entirely hedges. They were entirely hedges for my dividend farm, my covered call ETFs, my buy right and half right ETFs, and all my dividend growth, dividend income holdings across numerous sectors, that these are all just hedges for that. These could all go to zero. The 36% return in the system that I've developed is just a bonus. The 15% return in 2 weeks is just the bonus. The 2ET 25% returns that I've adjusted on directionless trades, and ET's barely even moved, were just bonuses to the system that I've built, where these are all just hedges for the monthly dividend income. These are all just hedges. These could all go to zero, and in the system that I've built, it'd be great. So that's what I've been doing. That's what I've been doing. And in economics, there's this principle called information asymmetry. I know what's in here. And I was a little jealous of these people for a little bit. I'm not going to lie. I was a little jealous of the people getting 500, 600 likes, just for sharing the bear porn. But then I saw this. And I stopped being jealous. My envy subsided. Because this is the top 200 volume and open interest screener from iVolatility.com. These are the stocks in the bottom of the implied volatility ranking percentile. So we got BITO, VXX, UVXY, and BIXY on the screener. And Albertsons. One of those should be a little suspicious. That it's in the top 200 options volume and open interest for the entire stock market, including ETFs. VIXY is in the top 200 volume and open interest, with UVXY and VXX. I stopped being jealous, and I started feeling bad. Because the MMs, they got a party plan. It's the same party they had planned for Oxy and XLE when they were telling retail the economy was going to shut down. It's the same party they had for these stocks in March of 2021 when we were, more shutdown porn, right? Pfizer, HD, Home Depot, Advanced Micro Devices, and Merck, and Royal Caribbean on the screener. Various reactions happening to these. Pfizer was really the one that got the directionless long gamma bucket started for me, because prior to Pfizer, I'd only been looking at straddles for the potential for a bias, where I was making a biased bet and then I had a hedge. After Pfizer, I realized that I don't need to make biases anymore. If a stock has low enough general implied volatility, its dollar price is, low. My sweet spot is between 9 to 15. The gamma is high enough to where I don't need to bet on the direction at all. But they got a party plan. It's going to be a similar party to what happened to Pfizer. It's going to be a similar party to what happened to Oxy and XLE. And I even think it's going to be a bigger party that we see happen to VIXY, UVXY, and VXX. There's a big party planned. The bears are saying that the party doesn't end until the VIX jumps into the 80s and SPY crashes to the 61.8% retracement of this 1, 2, 3, 4, 5 waves up. So they're saying this is all wave 1. That's wave 2. And so they're saying that this big party plan, this big party that's undeniably planned, this big party that is undoubtedly planned, is going to take the VIX to the 80s. It's going to take the S&P to 2,000, below 2,000. So I've got all these in the money puts, at the money puts on various value and growth tracking instruments. I got an awful lot of covered call ETFs. I got an awful lot of dividend holdings in case they're right. That only preparing for downside risk is all it takes. But I just want some of you guys to know that I've taken a cue from the MMs. I've taken a cue from the MMs. I've taken a cue from the MMs watching them for a while. Watching them for a while. What do? They go get out the weak. They go get out the weak. They have these scary corrections. They have these real scary corrections. They'll get Tesla within $1 of breaking this low. They'll get Tesla within $1 of breaking this low. They'll get Tesla within a couple dollars of breaking this low. They'll have Tesla just slightly clip this low. They get out the weak. They get out the weak. And I'm doing the same thing. I'm doing the same thing. I cordially invite every single person watching this video to unsubscribe from this channel right now. Unsubscribe from this channel right now. Unfollow me on FinTwit unless you really are one of those bears who says you're counter trading me. Just go. Just get the hell out. I see the people you're making famous. I see the people you're making famous. And like the MMs shaking people out of Tesla with these choppy consolidation periods, I've been doing the same thing, baby. You think I don't know people don't give a shit about value stocks that I tweet about? You think I don't know that no one really gives about the straddles, the strangles, the hedges, the risk management? You think I'm dumb? I know what I'm doing, fam. I'm getting out the weak. I've taken a cue from the MMs. Because I see who you guys are making famous. And I realize it's all for the better. It's not the cleanest analogy, but there's this song by Kanye West called Famous. And I just got to let you guys know, it's been playing through my head a lot in 2022. It's been playing through my head a lot in 2022, especially when I go on FinTwit, especially when I look at the stock market. It's probably the only verse that's remotely clean in this song I could ever put on the screen. But Mr. West says, I be Puerto Rican day parade floating, that Benz Marina Del Rey coasting. And this is the verse that's really stuck with me. It's really stuck with me in 2022. She in school to be a real estate agent. Last month, I helped her with the car payment. You guys are making a lot of people famous. And if you're not familiar with this song, I wouldn't listen to it without parental guidance. But the chorus goes, I made that be famous. I made that be famous. She in school to be a real estate agent. Last month I helped her with the car payment. I made that be famous. I made that be famous. Y'all are making people famous. Y'all are making people famous. I don't want any part of it. So just get the hell out. You know what I mean? I'm going to be unrolling and unrolling what's in this folder, and it's beautiful. It's beautiful. It leads to 34% returns in 2 months on directionless trades. Years of research. 15% returns on directionless trades in 2 weeks. 2 days ago. Multiple 25% returns on one stock that hasn't even really moved, that much. AG&C, just absurd returns. A 57% return in a month on a directionless trade, a 19% return in 1 day, a 27% return in less than 2 weeks. And these are all hedges. These are all hedges for the covered call ETFs and the dividend stocks and my just portfolio in general. These could all go to zero. So have fun. Have fun making bees famous. I want to see below 5K. I want it. I want you to push that unsubscribe button. Just like the MMs want you to sell Tesla. just like the MMs want you to do a lot of things, like, get the hell out of oil at the worst possible time. Start calling for SPY to go to 200 at the worst possible time. That's not what I think, but I am prepared for it. Here's what I do think. I think this is a 1, 2, 3, 4, 5 waves up for SPY. Wave 1 and an ABC correction. Wave 2 at the 50% retracement. The 61.8% fib of 318 is a great downside level to be above for this. We're getting a little far away from that. That's why I'm going to give a lot of other levels in this video for highly related instruments to SPY. I think this is a 1, 2, 3, 4, 5 waves up. This is wave 2 at the 50% retracement. So bulls will look for a wave 3 to begin. The length of wave 1 places the wave 2 low, gives a minimum wave 3 target in the low 600s. What bulls will also look for is for SPY to break above this weekly RSI high of 73.50. And then that's going to confirm, because there's a rule in Elliott wave theory that says SPY must end, that wave 5 must end with momentum divergence. So when SPY makes a new high and it breaks above 73.50 on the weekly RSI, from an Elliott wave perspective, that will confirm this is wave 3. 610 is the minimum wave 3 target. We'd expect a shallow wave 4 and a wave 5 higher after that. QQQ is identical to SOXX, but they're giving the best levels for tech and semis, so I'm going to really focus on them. This is a wave 1 and a wave 2 from the 2018 low, and this is a wave 3 and a wave 4. Now, the reason I stuttered there and almost said this is another wave 1 and another wave 2 is because it could be. It could be. Now, it's extremely aggressive, and I'm going to wait, just like with SPY, for a new high to be made on not just price, but the weekly RSI as well. But what my count right now for the Qs is that this is wave 1 and wave 2. This is wave 3 and wave 4. Wave 4 retested the wave 1 high. I'm looking for a wave 5 to begin. That's the length of wave 3, placed at the wave 4 low. That can take the Qs on an equal legs target up to 495. This wave 1 high of 237 is a great downside level to be above. And just like SPY, if we see a new high on the weekly RSI for the Qs, it's above 76.78. That will confirm this isn't wave 3 and wave 4. It's another wave 1 and another wave 2, because wave 5 must end with momentum divergence per Elliott wave. One example of that I've been using personally is that we see on SOXX's all-time chart, this high put in 2021 is the highest weekly RSI reading SOXX has ever made. That suggests in the big picture, that's not a wave 5 top that we put in. That's not something I can tell to my broker, but it is something that I've been using as evidence for myself that we're going to make new highs in tech. I think this is wave 1 and wave 2 for SOX. This is wave 3 and an ABC correction wave 4. Another one at the 61.8% retracement. Above this wave 1 high is super tight of 269. I like the 78.6% fib of 251 more for 1, 2, 3, 4, 5 waves up. The length of wave 3 placed at the wave 4 low would give an equal legs target of 279 for SOX. Here is Apple. It's giving nice short-term levels for market bulls, for the dopamine bulls that only care about the short term. I think Apple's going to be what they look for. 1, 2, 3, 4, 5 waves up. Wave 1, ABC. Wave 2 at the 61.8 to 78.6% fib. I want to see short-term bulls are going to want to see this wave 2 low of 129 hold. 127 is $2 away. That's 78.6% fib. What short-term bulls will say is that this is wave 1 and wave 2 will hold 129, and Apple will enter wave 3 of wave 3. It's a little similar to Amazon, but I think Apple's giving short-term levels for bulls that do kind of support that, maybe a little, I don't want to use the word melt up, but whatever happens, it's not going to be, this isn't going to be one of those trudge markets. Whatever happens, it's either going to be a crash to 200 or we're going to melt up and blow past 600. I've got my eyes on the latter in that situation. Here is Nvidia, but I'm prepared for the former. Here is Nvidia. Nvidia from the 2018 low, giving a little more aggressive view than SOX and the Qs. 1, 2, 3, 4, 5 waves up and an ABC correction at the 61.8 to 78.6% fib. I think Nvidia holds 98. That 78.6% fib is real pretty. I think institutions, just like they did in this range, they've been buying lots of straddles, and now they get to buy shares risk-free against those in-the-money puts while retail stops out. They've already managed their risk up front by buying these straddles. Now when the puts get deeper and deeper in the money and their negative deltas grow, they can buy shares of Nvidia against those puts risk-free. So if an institution buys a straddle, the call delta is 50, the put delta is negative 50, and then the stock falls so that the put delta becomes negative 80, negative 85, and has an 85% chance of expiring in the money. In theory, the institution who bought that straddle can then buy 85 shares of Nvidia that are quote-unquote risk-free if the delta is negative 85, because there's still going to be gamma on that put. So if Nvidia keeps falling, the delta will grow to 90, 95, 100, and the only 85 shares were bought. So it's going to continue to be a net bearish position. If Nvidia recovers, the gamma is going to kick back in. The put delta will shrink from negative 80 to negative 70 to negative 60, but the shareholder will have longed 80 shares, and it's going to become a net long position. So above 98, I think the MMs are going to get to not even use stops at all. They're going to get a risk-free ride past 346, buying against all these in-the-money puts from the straddles they've accumulated. Here is Amazon. Amazon from the 2018 low, very similar to a couple of stocks. I think there are a couple 2018 lows where we get all the way down to the 61.8% retracement of that rally. Nvidia's one of them. Amazon's one of them. 1, 2, 3, 4, 5 waves up for Amazon. ABC correction wave 2 at the 61.8 to 78.6% fib. Like Apple, bulls in the short term, the dopamine bulls are going to argue this is wave 1 and wave 2, and they're going to look for a short-term wave 3 to begin for Amazon and Apple. I'm more of a long-term bull. So I'm looking for 91.6 to not get broken. The length of wave 1 placed with wave 2 low gives a wave 3 equal legs target of about 224 in the long term before a shallow wave 4 and a wave 5 higher. Here's Starbucks, another XLY holding. 1, 2, 3, 4, 5 waves up. ABC correction wave 2 at the 61.8 to 78.6% fib. I think we hold 66. 68 is a little tighter. I'm in Starbucks for a long time, not a good time. It's going a little well so far. I'm in it for the growing dividend, but I think this is wave 1 and wave 2. I don't think Starbucks is the only dividend blue chip, the only genuine stocks where you go tell someone, hey, I'm buying Starbucks, I'm buying JP Morgan, I'm buying, Starbucks and JP Morgan, right? They're not going to be like, why, right? They're going to be like, oh yeah, those are basically semi-monopolies, and they're paying 4% dividends. That's going to be a real easy thing to say in hindsight above 126 when the dividend's 2%. I was more interested and still am interested in Starbucks when the dividend's closer to 3 or 4%. I don't know what the actual yield is right now. Here is XLY holding Starbucks and Amazon. 1, 2, 3, 4, 5 waves up, and Tesla. ABC correction wave 2 at the 61.8% fib. 110's a little wide. The length of wave 1 placed at the wave 2 low says that XLY can head up to 266 for a wave 3. 110 is a great invalidation. It's a little wide, but the dopamine bulls will argue again. That's wave 1. That's wave 2. They're going to put the tightest stop in the world right here and look for XLY to fly. I'm more interested in playing the long game, owning the commons, and having a stop below 110. And I'm not even using stops really. I'm using these straddles. So I'm just going to take the market to church if we crash. Here is Disney. Disney in the long term, another one, right? I'm buying Starbucks. I'm buying Disney. I'm buying Amazon. I'm buying JP Morgan. These aren't stocks that are going to make someone look like a genius when they make all-time highs. Everyone's going to say, duh, right? It's not easy to say duh at the 61.8 to 78.6% retracement. Disney's probably going to be the most profitable duh. I think this is 1, 2, 3, 4, 5 waves up for Disney. Wave 1 and wave 2, another wave 1 and another wave 2. It's travel, it's streaming, it's Mickey Mouse, right? There's not really another Disney, and those are all very common opinions at all-time highs. They're not very unpopular opinions. At 78.6% retracements. I think this is 1, 2 in the long term, and I think this is another wave 1 and another wave 2 in the short term. 79 is going to invalidate that short-term view. The length of wave 1 placed at the wave 2 low can take Disney beyond 216 for a wave 3 before a shallow wave 4 and a wave 5 higher. All in all, the long-term wave 3 target to me is going to take Disney into the 300s. Great RR above 79. And it's almost a bigger blue chip than JP Morgan. We saw some great action from the financials. I'm not going to, react to earnings. Don't care about any of that. But man, this is pretty, 4%, 3.5% yield on the stock that financed America. I mean, hey, at a certain point, there is a buy the business aspect to it, especially when it's a dividend growth stock. There is a buy the business. There's just the point where I gotta just hold Camping World and say I just own Camping World, and I own it for the dividend, and I just want exposure to that business. I want exposure to their cash flows, right? JP Morgan, Starbucks, yeah, I like them a lot technically. My views are entirely technical, but when I'm owning them, when I'm actually buying them, I know that there is a fundamental backing, and that's primarily for me. I'm not the fundamental guy. There are people on Finchwood who will forget more about fundamentals than I'll ever know, but I'll give you guys a few things that I look for. I'm looking for these high, a payout ratio above 25%. I'm looking for a growing dividend for the past couple, hopefully for over a decade of a growing dividend. Payout ratio well above 25%. One thing I know with a little bit of a background in business, I understand the return on assets equation. I understand profit margins. Not a very high ROA for JP Morgan, but if I am doing a dividend growth stock, what I'll look for just a little bit, I'm not the fundamental guy, growing dividend for over a decade, high payout ratio well above 20-25%, and then ideally a return on assets and profit margin are as high as possible. I'm not the fundamental guy, but if it's a dividend growth stock, that's one thing that I will look at. Just because there is, longs are buying businesses, and when they pay dividends, I think that, getting payout ratios and dividend growth history is just part of the statistics of, what's backing the downside risk. 1, 2, 3, 4, 5 waves up for the Morgans. Wave 1, wave 2, the 78.6% fib. 97 is pretty tight, but it's a great level. The length of wave 1 placed at the wave 2 low says a conservative wave 3 target is 196. Before a shallow wave 4 and a wave 5 higher, I own Simon Property. I don't update it because I should update these charts before I make these videos. I swore I did, but I do own Simon Property. I own Mid-America Apartments. I like them. I secretly think that a lot of these consumer stocks are just glorified real estate stocks. But anyway, that's a hot sports opinion. 171.12 for Simon Property, paying what, a 7%. So this is what I mean when I'm talking about if I am buying a dividend stock. There's just a few things that I'll look at. Again, this is something that people know a lot more about than me. Massive yield, 7% yield. So is it a dividend trap? Well, if I go look at the payout ratio is 125%. Doesn't feel like a dividend trap. The growing dividend for a long time, it did cut its dividend a little bit in the 2020 pandemic, but we've seen at least REITs are required to pay some of their income, or a good amount of their income, in the form of dividends. Massive return on assets, 6%. 43% profit margins. Again, not the fundamental guy, but just a couple things that I look at. Very high payout ratio. So I think this is a dividend growth stock. And another thing that I can look at specifically for a REIT, well, not this REIT because the price to book ratio is 9.66, but because there's so much physical assets backing the REITs, I do want that price to book ratio to be as low as possible. Simon Property is a real leader in the REITs, so the price to book ratio isn't going to go as low as a mortgage-backed REIT. Anyway, above 69, the length of wave 1 placed at the wave 2 low is going to take Simon Property to 214 for a minimum wave 3 target before a shallow wave 4 and a wave 5 higher. I own Simon Property and Mid-America Apartments. I own a couple other REITs. And I'm just buying them against the AG&C puts, because I'm not going to move the strike prices on the AG&C straddle from 9 to 8. There's reasons why I don't go below 9 normally. But anyway, that's all for a different video. Ford, 1, 2, 3, 4, 5 waves up. Kind of good evidence for transportation. Kind of good evidence for consumer cyclical stocks in general. Wave 1 and wave 2 between the 61.8 and 78.6% fib. 8.69 is a little tight. 8 rounding down might be a little better, but I do think this is a real pretty wave 1 and wave 2. We make a new high on the weekly RSI, supporting the idea this isn't a large wave 5 that it's occurred. I think it's a wave one and a wave two. And I think Ford, Tesla bulls are going to really want to watch Ford. Consumer bulls, transportation bulls, market bulls. Ford is a beautiful piece of evidence. Wave one and wave two, new high on the weekly RSI. And then even zooming out, I think this is another wave one and another wave two. I don't have it labeled because the short-term view is the only view really necessary for Ford, but this could be a nest in the big picture for Ford as well. Don't need to really even think about that right now. A similar idea with Camping World, similar idea, consumer stock and auto-related stock. I think this is an IPO base breakout. Remember, just because the stock breaks the IPO low, that doesn't mean the Elliott wave proper view is that it's in a bear market forever. Okay, so the all else being equal, an Elliott wave theorist wants more chart history than less. From a risk-reward perspective, there's going to be a lot more reward on stocks that do have less chart history. So that is kind of the balance. Just because the stock breaks an IPO low, it doesn't mean it's in the super bear forever. I think this is a wave one and a wave two. I think this is another wave one and another wave two for Camping World. I'm honestly not going to, I don't have a stop on Camping World. I'm going to hold it just forever. I've held Camping World for a bit. I originally bought it here. I took a leap position. I cashed out the leap position. I kept holding the shares. I only sold a couple of shares, during this little slide, but I mostly have a full position right now, right around where I entered it. I've trimmed it a little bit, but it's a nice position for me, and I'm just gonna hold it. It's part of the dividend. I actually haven't looked at some of these fundamental metrics for Camping World, so you guys can just kind of see my reaction. Price to book ratio, 6.89. Nothing really too interesting about that. We see the dividend growth has been pretty impressive. Marcus Limon is just jacking up the dividend in recent years, and not because it's a trap. They have the money to support this. An 84% dividend payout ratio. That's massive. That this is a huge dividend, and the payout ratio is 84%. They could even keep growing this. I like the return on assets 5%. That's pretty nice. Profit margin 4%. Return on equity, I'm a little careful with because that could be affected by dilution. But anyway, Camping World, I like it. I own it, and I'm going to keep holding it. It's a stock that I just want to own, collect the dividends from, and if it goes to zero, it goes to zero. I think that the kind of cash flow from the dividend payment suggests that if the more Camping World falls, the higher the dividend yield's going to get. Lemonis might even raise that dividend again, and if Camping World fell, we'd be in the 12% yield, the whatever yield. So there's a little bit of a fundamental backing to some of these. Here is Boeing. No fundamental backing to Boeing, right? Because everyone's an accountant, there is debt or whatever. I'm not the obviously everyone says that every value stock just has too much debt. So that's kind of like the go-to fundamental analysis for a value stock is it just has too much debt. I'm not an expert in debt, so can't argue with that. But I think that Boeing is a 1, 2, 3, 4, 5 waves up, wave one and a wave two. I think this is another wave one and another wave two. 89 is the wave one in validation. There's probably better levels from other transports like the autos, even lots of the airlines, obviously. But I think this is a wave one and a wave two. Above 89, Boeing could get extremely explosive. That 161.8% extension. I know it sounds goofy right now, but that's the classic wave three target in the upper 300s for Boeing. So I am looking for Boeing to go to the upper 300s, above 89. I know 89 is a little wide, so I want to include in another airline. I tweet about the airlines a lot. I think I tweet about the airlines a lot. People think the airlines are boring, so if I tweet about the airlines, then, people, oh, you're just tweeting about something that's boring, I guess. I don't know. Anyway, Delta Airlines, these airlines are going to be boring for long. 1, 2, 3, 4, 5 waves up, wave one and wave two for Delta Airlines. I think this is another wave one and another wave two at the 61.8 to 78.6% fib. 24 is a great level to be above. The length of wave one placed with wave two gives a wave three target, maybe a little more near term than Boeing going to 390. Would be Delta Airlines going to 61 before a shallow wave four and a wave five higher. All in all, waves 1, 2, 3, 4, and 5 can take Delta Airlines significantly higher in the long term above this wave one all-time high. 24 is a great level to be above. A nice level for the airlines. Silver, SLV, wanted to talk more about commodities. They always kind of get the short end of the stick. I think this is wave one and wave two for SLV. I think this is another wave one and another wave two at the 61.8 to 78.6% fib. I still do use Andrew's pitchforks. There are character limits in tweets. And there is a point where, there is some subjectivity in technical analysis. Now, risk management, I don't think there's any subjectivity in risk management. I think risk management is all betas, gammas, and thetas. And correlation coefficients. I think risk management is completely statistical. Technical analysis, there is a little bit of subjectivity, and pitchforks might be part of that, but I think this is a wave 1 and wave 2. I take the beginning of wave 1, connect it with the high of wave 1 and the low of wave 2. I got an Andrews pitchfork in the long term, where I ultimately think the crazy median run is going to occur in the short term. It looks like this is a wave 1 and a wave 2, where we have a little bit of a conflation. We're on the lower bound of the pitchfork, where we can see a nice little reaction. We're also between the 61.8 to 78.6% fib, 14 to 14.50. Nice level to be above. The wave 3 equal legs target is 33. If we made a new weekly RSI, a new monthly RSI high, for the monthly RSI at 75, that would confirm this is wave 3 of wave 3. I think it's going to be wave 3 of wave 3. Anyway, the 161.8% extension is 38 before a shallow wave 4 and a wave 5 higher. Here's UEC, Uranium Energy Corp. Just wanted to touch on this commodity just a little bit. I know this looks like a lot of one twos, but I do think that the most important count for UEC, just to be clear, is within the cycle from the January low, that this is wave 1 and wave 2. So above that low of 2.46, which is super wide from the current levels, tighter, almost too tight, would be 2.92. I think UEC is going to form wave 1, wave 2, and begin a big wave 3. The length of wave 1 placed at the wave 2 low gives a wave 3 target of +7 before a shallow wave 4 and a wave 5 higher. If UEC gets going, that wave 3 is going to blow past 7. Here is Tesla. Tesla in the short term did not form a wave 1 and a wave 2 on the small degree, but I do think it's forming a wave 1 and a wave 2 on the large degree. I think this is a wave 1 from 179 to 414. I think this is an ABC correction that's ended wave 2, and we're going to see Tesla begin wave 3 of wave 3. I want to see 179 not get broken. That will invalidate that this is a wave 1 and a wave 2 for Tesla. But if 179 isn't broken, and this is wave 1 and wave 2, wave 3 is not going to stop at 440. Wave 3 is going to blow past the 440s. That's a minimum target before a shallow wave 4 and a wave 5 higher. Let's say all that happens. Wave 3 blows past the 440s and a wave 4 retests the wave 1 high. Well, wave 5 is usually at least the length of wave 1 placed at the wave 4 low. We could see Tesla go higher than the mid 400s in the long term. Maybe add $100 to that, or even $200 to that if we're above 179. So there's a lot of RR to the upside. I believe and suspect that just like before this rally, that the institutions are using straddles on Tesla to manage that downside risk and using these red periods to buy against those in the money puts and enter risk-free positions. I think Tesla's going to go 3 for 3 on the bar chart straddle screen and start heading into the mid 400s above 179. First Solar supporting that idea. A multi-year nest, a decade-long base, and right. This was a failed breakout. Remember, this was a break. Oh, it's a fake out, failed breakout. Well, from failed moves come fast moves. So First Solar should be at 4 right now. No, that was a breakout and back test of the classical base, right? So all forms of TA are completely worthless if you're just wishy-washy and are going to do whatever kind of the financial media and kind of the retail sentiment is telling you. This was a massive base. This was a breakout and back test of that base, but it's rarely called a back test. It's usually called a failed move, and from failed moves come fast moves. But that didn't work out, and that's not to everyone. Everyone gets it wrong. I get it wrong all the time. I'm probably gonna get plenty of stuff in this video wrong. I'm gonna get lots of stuff wrong. I'm gonna be wrong about half the stocks I talk about for the rest of my life, at least. But what I've been doing for the past 2 years is building a system where me being right and wrong doesn't matter. It's not going to matter to the straddles and the strangles that are just being used to hedge the dividend farm that I've been building, the dividend farming system where all of these straddles and strangles are just acting as insurance policies essentially. And even if they did reach decay, and I just had them decay until 2 months till expiration, I'd be collecting enough dividends from monthly dividend holdings as well as dividend growth and dividend income holdings to make it worth it, right? So I'm going to be wrong about half the stuff that I talk about, right? So is everyone else. That's why for 2 years I've been building this system where me being right and wrong is just going to be a bonus. And I think that for First Solar, this is wave 1 and wave 2. The length of wave 1 placed at the wave 2 low has almost seen that minimum target get hit. Not yet, though, of 154. The wave 3 textbook target is 181. I think that's where First Solar is heading next. I got 181 is my next target. Enphase Energy, a pretty one. Let's see. Can I do a weekly chart on Enphase? I got to scroll over a little bit. I think this is a wave 1 and wave 2. That was confirmed when we broke to a new high. So what I'm looking for Enphase is that this is a large wave 3 in progress. I'll get into the subdivision right now. This is wave 1 and wave 2. This is a large wave 3 in progress. This is wave 1 of wave 3, wave 2 of wave 3, wave 3 of wave 3, and wave 4 of wave 3. So I think we'll see wave 5 of wave 3 develop. The 161.8% extension of wave 1 is 380. Now I don't have a stop for Enphase because it's in the driver's seat. When a winner runs like this and it's up 50-60%, what I'll do is, let's say I bought Enphase Energy at 140 and then it goes up to 200 and I've got I'm about to show you guys how bad I am at math. I've got a 30% return. I could sell 30% of that position, take everything that's profit away from Enphase Energy and still have the remaining position size. So that's what I'll do if I have a winner running. So I don't have a stop for this Enphase setup because the original posts were in this range. And so this is in the letting the winner run category. If I'm up 50%, 40% on a stock like this, I'll sell the 40% that's in profit and keep that original exposure. One example of me doing that was uranium fuels. I took a large position in uranium fuels at 450. When it got to 11, I sold half of it, so I still had my original exposure to UUUU, and I still was able to take a good amount of, or I was able to take a nice amount of profit off before UUU pulled back, and that's why I was able to keep holding uranium fuels because I'd already taken what was already profit for me. Here is Plug Power, another one. The MMs are simply using straddles and strangles to manage downside risk. If one takes the wonderful vocation of studying the bar chart, straddle and strangle screener, studying the iVolatility.com liquidity screen, they'll learn more about stocks and investing and markets than in 3 months than most people will learn in their lifetimes. And an undeniable conclusion will be that institutions are using straddles and strangles to hedge positions. This is a Plug Power, a wave 1 and a wave 2 at the 78.6% fib. I think in the short term, Plug's forming another wave 1 and another wave 2 above 12.70 is a little tight, but I do think Plug's going to begin wave 3 of wave 3 to the upside. I think for Plug, probably Tesla is a good chart. I posted about TAN recently. The downside levels for TAN is 55, so I think Plug bulls are going to look for 55 to not get broken on TAN. They're going to want the Tesla setup above 179 to play out. They're going to want 12.70 to not get broken. Plug is in ICLN. It should be a leverage play on that clean energy sector. Shoulda, coulda, and woulda aren't very good traders. Here is NEO. NEO breaks below the IPO low. Doesn't mean it's the end of the world. Doesn't mean it's in the super bear forever. And I think NEO formed a large wave 1 and a wave 2 at the 78.6% fib. NEO's broken all lows. There's no low for NEO bulls to trade against. There's no low for NEO bulls to stop out against, right? The only way to play NEO and so many growth stocks in this market, not just in this market, but in the market historically, has been to take the bag holder risks, to say, yeah, I could be wrong about this, and this could go to zero. This could be a scam, right? That is the risk. That's why I take much smaller positions in growth stocks. I took a half position in Li Auto at 25 and a half position in Xpeng at 29 in March of 2021. I held through rallies, I held through dips, and I'm still holding through a dip because I wanted to be exposed to Chinese growth for a decade when I bought those stocks, and I still do. Now I get to buy the Chinese growth stocks that I haven't bought yet, like NetEase, like, even some of the ETFs like KWeb. But right now I'm just, if China goes to zero, China went to zero. And I don't think that's going to happen, that the Chinese market, the Chinese growth stocks, Alibaba, NetEase, the Hang Seng, are going to go to zero. I think the exact opposite is going to happen. I think NIO is going to end up being a huge leverage play on that sector. The MMs have bought straddles and strangles on NIO in this range. I had 30, and I think I had 30 and 26 as stops that got broken. And the MMs, they didn't have to stop out. They had all of these puts that were in the money, and they get to buy against them risk-free, and they've continued to buy straddles all the way down. So I think that the institutions are still loading up straddles and strangles on NIO and Tesla and stocks like Ford, getting ready for this huge rally in EV and transportation that I expect is coming in Ford. I expect it's coming in Tesla. I expect it's coming in, clean energy and transportation in general. And I think NIO is going to benefit from that a lot. And I do think it's NIO and Xpeng and Li could be, the Chinese versions of Tesla. But Tesla was extremely volatile in the early days. It was extremely difficult to hold. And I still own Xpeng. I still own Li, even though they're getting close or have broken these IPO lows. Just because the stock breaks the IPO low doesn't mean it's in a bear forever. So I'm going to hold Xpeng and Li. If Chinese growth and Chinese EV goes to zero, I manage that risk with position size. But I do think this is going to end up being an IPO base. I think stocks like Pounder, stocks like Space, even stocks like Rocket Mortgage and Coinbase, and there's a lot of stocks that have broken this IPO low with the ABC correction. It doesn't mean they're in bears forever, but it does mean they don't have lows to trade against. And it does mean that the institutions using straddles are in a big advantage to retail right now, because they can buy against those positions, those bloated puts risk-free. I have the metaverse straddles, and I have the gaming straddles. If growth does continue to collapse, I don't expect that's going to occur. I think that Xpeng is going to enter wave 3, form a low, and then start building the right side of this IPO base. So I'm an Xpeng for a long time. Not a good time, but I think stocks like NetEase, and I do the Hang Seng a lot. I'm just going to do NetEase in this video, support the idea that China's a huge opportunity. And I know after a year, hearing the word opportunity, gets, it gets a little old, right? But this is a wave 1 and a wave 2 for NetEase. This is kind of, few things will track Chinese internet better than this. And I think this is another wave 1 and another wave 2 for NetEase. We're between the 61.8 to 78.6% fib. 57 is ridiculously tight, not really even useful at all right now, but we're between the 61.8 to 78.6% fib for NetEase. And I think that we're going to see NetEase begin wave 3 of wave 3 with Alibaba, with the Chinese growth stocks in general. Let's see if the Hang Seng, I think the Hang Seng above 15K. I haven't looked at the Hang Seng recently, so it's pretty damn close to 15K. Yeah, I mean, they're taking these Chinese stocks to the 78.6% fib. They're making retail take the bag holder risk, and I'm taking the bag holder risk because I think it's worth it. I think that this is a wave 1 and a wave 2 for the Hang Seng. This is another wave 1 and another wave 2, and a wave 3 of wave 3 beginning in China for the whole Chinese market. As massive as that market is, that's almost a bigger danger to me than commodities going on a multi-year run. It's a bigger danger to me almost than crypto going on a multi-year run. I think there's huge upside risk. I think a lot of Americans, they're only in, they think being long, they think being in stocks just means owning the S&P, owning the Qs. That might work out for maybe 1 or 2 more decades, but I don't think that's going to be what happens in the long term. I think that we are going to see these foreign markets at some point in the future, years down the road, start to heavily outperform the American indices. And I think that the current status quo of being long, just meaning that someone owns the S&P and the Qs, doesn't have any foreign market exposure. I think the practice of 401k plans and Roths not even having foreign market exposure as an option. I think that's going to be long gone by the time we see what happens to the Hong Seng. Here is Roku. Roku is in ARK. Certainly one the Bears have been more correct about, in, the medium term. I still think this is 1, 2, 3, 4, 5 waves up. This is wave 1. That's wave 2. Roku is it's broken below this wave too low. I mean, it's taken every single stop that could possibly be used. Now 26, the all-time low, 15, sorry. 15 is the wave 1 invalidation. That's ridiculously far invalidation. And that's kind of the whole point. The MMs are using straddles and strangles on Roku and all these growth stocks to manage that downside risk. Now they get to buy against those bloated puts risk-free while retail stops out and calls, these future Netflixes, these future Teslas, these future Amazons, at least from a price perspective, scams and whatever, right? So I've got the metaverse straddles. I've got the bet straddles. If growth keeps collapsing, the MMs just have straddles on these stocks in general. And they're buying against those bloated puts right now. I suspect they are buying against those bloated puts. The proper procedure, I guess, the technically correct procedure from an Elliott wave perspective is to wait for a wave 1 and a wave 2 to develop, have the wave 1 low to trade against for wave 3 or wave 3. I take that bag holder risk for growth up front, manage the risk with position size and straddles on growth ETFs, because I know that's just that's just going to get chopped to pieces trying to do that. It sounds good on paper. In reality, just getting laughed at is really the only way to catch some of these growth monsters. Square Cash, another one. What if it was a future Visa? What if it was a, future, but before anyone can say that, it's like, well, no, it's down right here. It's a scam bubble, right? So it's down right here. It's going to be down forever. A lot of people say they want to get the next Amazon. If there's the next Amazon in the market, it's probably Square Cash and Shopify. And if we look at the charts of Visa and MasterCard and Amazon in 2008, there's a lot of 78.6% retracements that get clipped. There's a lot of bag holder. There's a lot of .com growth scam bubble, whatever. And then what happens is just no one could have ever predicted how bullish that was going to play out. And I think this is a similar view that I have with Roku and Square and Bitcoin. I can give the long-term targets. I can give the minimum wave 3 targets. But realistically, if these are super cycle nest lows that are put in, and the nest just means 1, 2, 1, 2, wave 3 begins, we're blowing past these equal legs targets. We're not. This is all going to be a blimp on Square Cash's long-term chart. It's going to look like this. This little area over here. If 1, 2, 1, 2, wave 3 plays out, right? So right now it is. Growth goes to zero, or, these were Amazons in 2009. These were Teslas in 2020. They were, Netflixes in 2011. But they're not easy. So here is Space. I think Space is a good example of stocks breaking the IPO low, not necessarily meaning it's in a bear forever. I mean, if right now, I know this sounds silly, but if Space goes to zero, it loses $4.45 per share. And if Space breaks this wave 1 high, it gains what? $56 per share? $60-ish per share. I mean, even the risk reward right there, no Elliott waves involved, says that's pretty incredible. I think this is an ABC correction. The length of wave A, place of wave B high is where wave C is ending for Space. We're going to see a wave 1 and wave 2 develop. There's going to be some stupid headline, some ridiculously dumb thing that just doesn't make any sense. And I think we're going to see Space up 60% in pre-market one day. Everyone's going to be like, oh, wow, like, blah, blah, blah. And, it's like that's all fun to say. I'm not interested in saying stuff like that. I'm interested in owning it. I'm interested in knowing that there's going to be some BS news announcement that no one knows about. And we see Space flying up into the 50s, and then everyone's, yeah, I'm just not in the market for that gossipy scandal bullshit. I'm really not. So, and a lot of people are. There was a quote a long time ago that I read that's always stuck with me, and it just seems silly, when you're starting out, right? But it was just, the quote is, most people No, the quote is, everyone gets what they want out of the market. Some people like to lose money, so they get what they want by losing money. And, that sounds like a ridiculous kind of furu thing to say. Oh, people want to lose money. They're masochists. They like losing money. That's why retail bag holders lose money. Okay. But I think there is a lot of truth to that statement. Everyone gets what they want out of the market, right? And what a lot of people don't understand is mentally and financially, they've put themselves in a position where they're not retiring till 65. Like, they know that. It doesn't matter how much money they make in the stock market, if any. They know they're not retiring until 65. So to them, the stock market is just a form of entertainment. And just understand that. Just really think about this. How many people treat the stock market the exact same way they treat watching football, and the exact same way they treat watching very politicized news? Far right, far left, CNN versus Fox News. Bulls, Bears, CNN, Fox News. How many people just treat the market like that, right? Ohio State, Michigan, Bulls, Bears, Fox News, CNN. You're in the market for entertainment. And a lot of people don't realize that. Like, so many people are genuinely in the market for entertainment, to be a part of a broader conversation. And that's why so many people can just make bank posting scandalous crap like this, right? That's why so many people are able to make livings, charging $60, $70 a month, $80 a month, just with scandalous BS. I mean, right? Because most people are in the market for entertainment, right? They don't realize it, but they are. This is just the Cowboys and the Eagles to you. This is literally, they literally have the Chicago sports teams where the options market is headed. The CBOE, the Chicago sports teams, are the Bulls and the Bears. Just think about that. The sports teams for where the options market is headed are called the Bulls and the Bears. They want you to think of this as football. The Bears are losing. Now they got Michael Jordan. Like, what the? Anyway, the Bulls got Michael Jordan. My bad. We need MJ to come back. MJ's playing baseball right now. Someone get his ass off the bus. 1, 2, 3, 4, 5 waves up. There was a ESPN documentary came out called Jordan Rides the Bus that I'm referencing, by the way. So in the 1990s, Michael Jordan, greatest basketball player ever. His father died, wanted him to be a baseball player apparently. So Michael Jordan took 2 years off from the Bulls to play baseball. And so the greatest athlete ever, a world famous, known, he could be recognized in China, recognized in any country around the world. He's riding a bus with a minor league baseball team. So that's what I was referencing. The Bulls, the Bears. It's all supposed to be to us like we're just watching sports. The Cowboys are winning. Now the Eagles are winning. Carson Wentz just broke his leg. Like, and it's not football, right? The MMs aren't treating this like football. The MMs are treating this like a boring math problem. They're buying lots of straddles on the Bitcoin ETF, and then when Bitcoin falls, they're buying Bitcoin against those straddles. It's boring. It's boring. It's lame AF. They're buying straddles on Bitcoin, and then when Bitcoin falls, they buy shares against the It's not fun. It's not right and wrong. It's not Bulls and Bears. It's boring. 1, 2, 3, 4, 5 waves up for Bitcoin. ABC wave 2 between the 61.8 and 78.6% fib. I like 14.8K. 13.8K is a little wide. I think Bitcoin begins wave 3 of wave 3 for crypto. Ethereum is giving much better levels in the short term. And I mean, these stocks have just been sideways for a little bit. Some people have pointed out how low the volatility has been. Look at this. Look at this. You think Ethereum's just going to go stay sideways? Ethereum hasn't moved for a month. It hasn't moved $1 in a month. They're getting ready for something. There's a party planned. There's a party plan. I think this is 1, 2, 3, 4, 5 waves up. And this is an ABC correction at the 78.6% fib. And there's a big party planned. Not just in the market. It's not about the stock market. Who cares about the stock market? If SPY goes up to 600, that's a what? A 35% return. Right? But what if, hear me out, what if during that time, silver went from 17 to 33, 38, and doubled? Right? What if some of these oil counts played out? And we started seeing stocks like ET, stocks like BP, stocks like Petrobras. What if we started seeing some of these crazy wave threes in energy play out? What if we saw Ethereum and Bitcoin begin these massive wave threes? Then guess what? Owning the S&P and catching all that to 600 wouldn't be enough.